$300 billion is a number that is almost impossible to visualize until it vanishes from the balance sheets of the American banking system in a single morning. We are watching a financial demolition derby, but the cars being smashed are the skyscrapers that define the skylines of New York, San Francisco, and Los Angeles. A coordinated massive liquidation order has just been executed by the largest state-linked property developers in China, and it has flooded the U.S. market with distressed assets. This is not a standard market correction where prices drift lower over months. This is a violent, instant reset of asset values that destroys the foundation of credit. The order came from Beijing, directed at entities like Greenland Holdings and Oceanwide, to repatriate foreign capital immediately to plug the gaping holes in China's domestic debt crisis. They have listed trophy assets across the United States with an explicit instruction: sell them today and sell them for whatever you can get. The asking prices are shocking the institutional brokerage community, hovering at roughly 30 cents on the dollar compared to valuations from just 2 years ago. This 70% haircut is not just a loss for the Chinese sellers. It is a catastrophic mark-to-market event for every U.S. bank that holds a loan on a similar building. When a flagship tower in Manhattan sells for a fraction of its construction cost, every other building in that zip code is instantly repriced to that new, lower benchmark. This creates a terrifying mathematical reality for regional banks. The collateral backing their billions in loans is now worth less than the paper it is printed on. We are witnessing the end of the extend and pretend era, where bankers and landlords conspired to ignore the reality of empty offices and soaring interest rates. China has just ripped the mask off the U.S. commercial real estate market, exposing the rot that has been festering since the work-from-home revolution began. The epicenter of this crisis is not the massive, too-big-to-fail banks on Wall Street, but the hundreds of regional lenders that serve Main Street America. These smaller institutions hold nearly 70% of all commercial real estate debt in the country, a concentration of risk that is now proving fatal. This fire sale is the precise trigger event that regulators have feared for years, a gray rhino that everyone saw coming but no one prepared for. But before we break down exactly which banks are in the danger zone, make sure you are subscribed to Finance Mind for the unfiltered truth about your money. The scale of this dump is strategic. It is designed to maximize pain in the U.S. credit markets while salvaging hard currency for the Chinese state. We are seeing projects that were stalled or unfinished, like the Oceanwide Center in San Francisco, effectively being sold for the value of the land alone. The Greenland Group is marketing its massive metropolis project in Los Angeles as a distressed opportunity, signaling desperation to the global sharks. These are not failed American businesses filing for bankruptcy. These are foreign sovereign-linked entities liquidating their American footprint. The speed of this exit has created a complete vacuum of liquidity in the property market, a phenomenon known as a no-bid environment. Institutional investors like Blackstone and Starwood are sitting on the sidelines, refusing to catch a falling knife until the dust settles. This buyer's strike means that for anyone else trying to sell a building today, the value is effectively zero because there is no one on the other side of the trade. When liquidity vanishes, volatility explodes, and the panic begins to seep from the boardroom to the bank branch. We are already receiving reports of margin calls being issued to U.S. developers who use their properties as collateral for other loans. Banks are demanding more cash to cover the drop in an asset value, but the developers are cash poor and asset rich. This forces them to join the fire sale, adding even more supply to a market that is already drowning in unwanted office space. It is a classic deflationary death spiral, fed by the massive inventory dump coming from the other side of the Pacific. The Federal Reserve is watching this unfold with a sense of dread because their standard toolkit is useless against an asset price collapse. Jerome Powell cannot print a tenant for a vacant office tower, nor can he force a Chinese developer to hold on to an asset they want to dump. The problem is not the cost of borrowing money. The problem is that the underlying asset has become toxic. The vacancy rates in major U.S. cities were already hovering near record highs, with some districts seeing 30% of their space empty. Now, with this fire sale, the implied value of that empty space has dropped to negative territory in many cases. This means the cost to maintain, tax, and insure the building is higher than the potential rent it could ever generate. We are looking at the creation of zombie towers that will loom over our cities for a decade, empty monuments to a credit cycle that has burst. But the immediate danger is to your personal bank account and the stability of the institution where you keep your savings. When a bank's loan book takes a hit of this magnitude, its capital reserves, the buffer meant to protect depositors, are wiped out instantly. This triggers an immediate regulatory seizure, usually executed on a Friday evening to prevent a panic, but the rumors are already circulating. We have identified 5 major regional banks that have catastrophic exposure to the specific markets where China is dumping assets. Their stock prices are plummeting in pre-market trading as hedge funds and smart money rush to short them into oblivion. The short sellers smell blood in the water. betting that the FDIC will have to step in before the week is over. Rumors are flying on trading desks that a bail-in scenario is being discussed, where uninsured depositors might take a haircut. This is why we have constantly warned you. Never keep more than the FDIC insured limit in any single regional bank. The contagion is spreading fast because these banks lend to each other in the overnight repo markets. The interbank lending market is beginning to freeze as banks stop trusting the solvency of their neighbors. It is a silent panic, invisible to the average person on the street, until they go to an ATM and see an error message. The credit crunch that follows this event will be brutal for every small business in America. If you run a bakery, a mechanic shop, or a construction firm, you rely on these regional banks for your operating lines of credit. When the bank goes into survival mode, the first thing they do is cut those credit lines to preserve cash. This chokes off the real economy, leading to immediate layoffs and a recession that starts on Main Street, not Wall Street. China understands this fragility better than our own politicians do. They have studied the U.S. financial system for decades. By targeting the commercial real estate sector, they have struck the Achilles heel of the American economy. They use their massive ownership of U.S. soil as a geopolitical lever, pulling it at the moment of maximum vulnerability. It is a form of asymmetric financial warfare that uses property deeds and mortgage bonds instead of missiles and tanks. The legal structure of these sales is also designed to create maximum chaos in the courts. They are selling the corporate entities that own the buildings, transferring the debt and the legal liabilities to new, often shadowy owners. Title, insurance companies are freezing new policies on these properties because they cannot verify the chain of custody. This freezes the market even further, ensuring that the damage is prolonged and the recovery will take years. We are also seeing massive U.S. pension funds caught in the crossfire of this liquidation event. Many state and teacher pension funds are heavily invested in commercial real estate as a safe income-generating asset class. They are now holding portfolios of worthless paper, putting the retirement security of millions of public servants at risk. The safe asset trap has snapped shut, catching the most conservative investors completely off guard. This $300 billion dump effectively re-rates the entire U.S. asset class downward by half. It forces a reckoning with the extend and pretend accounting tricks that regulators have allowed since 2020. Banks can no longer pretend a loan is performing when the building next door just sold for scrap value. The mark-to-fantasy accounting is over. The mark-to-market reality has arrived with a vengeance. And the reality is ugly, bloody, and incredibly expensive for the American taxpayer who will likely foot the bill. The U.S. Treasury may be forced to intervene with a new version of the TARP program to stabilize the regional banks. But any bailout of this size will be inflationary, further eroding the purchasing power of the dollar in your pocket. They will try to save the banks by printing money, which is essentially a hidden tax on every saver in the country. The China dump is forcing the U.S. government into a corner. Choose hyperinflation or a deflationary banking collapse. There is no third option, and the clock is ticking on the decision that will define the next decade. The geopolitical timing is also incredibly suspicious, coinciding with rising tensions in the Taiwan Strait. Is this a financial preemptive strike? A warning shot across the bow of the U.S. economy to deter military action? It certainly looks that way to anyone who analyzes the flows of capital as a weapon of statecraft. The decoupling is no longer a slow, careful drift. It is a violent, chaotic separation of two conjoined economies. And in a divorce this messy, the assets get sold for whatever they can bring, regardless of the loss. Unfortunately, the assets being sold are the buildings where Americans work, live, and shop. The ghost cities phenomenon, once famous in China, is coming to the United States. We are watching the Detroitification of San Francisco, Chicago, and New York in fast forward. The tax base of these major cities will collapse as property values plunge, leading to a fiscal crisis for local governments. This leads to cuts in police, sanitation, and schools, creating a downward spiral of urban decay that drives more people away. It is a systemic crisis that starts with a spreadsheet in a Beijing office and ends with a pothole in your street. The $300 billion headline is just the start. The real story is the destruction of the American urban model. We're entering a new phase of the global crisis where financial assets become dangerous liabilities. Owning a skyscraper is now a liability. Owning a bank stock is a gamble. Owning debt is a trap. The only safe harbor is in assets that do not have a counterparty risk and cannot be printed or devalued. Gold, land, and tangible commodities are the only things that cannot be destroyed by a Chinese fire sale. But for the banking system, there's no escape from the math that has just been unleashed. The dominoes are lined up perfectly, and the first massive block has just tipped over with a thunderous crash. The sound you hear is the value of $300 billion vanishing into thin air, never to return. And the silence that follows is the sound of a credit system that has stopped breathing. The regional banking crisis of 2026 has officially begun, and it was triggered from across the ocean. You must look at your own financial exposure today, not tomorrow, because the window to act is closing. Check your bank's health, check your investments, and understand the storm that is making landfall. This is not fear-mongering. This is reading the balance sheet of the world's largest liquidation sale. The for-sale signs are real, the losses are real, and the consequences will be felt by every American family. We are going to track every dollar of this dump and tell you exactly where the next blow will land. But for now, understand that the rules of the game have changed overnight. The era of easy credit and inflated asset values is officially over. Welcome to the Great Reset of American real estate, courtesy of the People's Republic of China. To fully grasp the magnitude of this disaster, you must understand the mechanical doom loop that China has just activated within the American financial machine. This is not just about buildings losing value. It is about the destruction of the collateral that underpins the daily operations of the entire U.S. economy. The doom loop begins when the value of the property falls below the value of the loan, a state known in the industry as being underwater. In a normal market, a bank would work with the borrower to restructure the loan, extending the term or lowering the rate to keep the loan alive. But China has removed that option by flooding the market with comparable sales that are priced at 30 cents on the dollar. This forces the bank to immediately recognize the loss on their balance sheet, a regulatory requirement that cannot be ignored or delayed. When a bank recognizes a loss of this size, it depletes its Tier 1 capital, the emergency funds it is required by law to hold. If Tier 1 capital drops below a certain threshold, the regulators at the FDIC are legally mandated to seize the bank and shut it down. This is the death zone that dozens of regional banks have just entered this morning as the new valuation data hits their books. They are frantically trying to raise new capital to plug the hole, but who would invest in a bank that is effectively insolvent? The result is a liquidity trap, where the bank stops all lending, calls in existing loans, and hoards cash to survive the day. This brings us to the second, and arguably more dangerous, victim of this fire sale, the Commercial Mortgage-Backed Securities, CMBS market. These are bonds that are backed by bundles of loans on office towers, hotels and malls, sold to pension funds and insurance companies. For years, Wall Street packaged toxic real estate loans into these bonds and slapped a spare A rating on them, calling them safe. Today, those bonds are being exposed as worthless because the underlying buildings are selling for scrap value. We are seeing a complete freeze in the CMBS market, with trading volumes dropping to zero because no one knows what anything is worth. This means that the refinancing engine of the U.S. real estate market has officially seized up and stopped working. In 2026, there is a maturity wall of over $500 billion in commercial loans that need to be refinanced. Normally, the borrower would just get a new loan to pay off the old one, keeping the game going for another 5 years. But with the CMBS market frozen by the Chinese dump, there is no new loan available at any price. This forces the borrower to default, handing the keys to the building back to the lender, who then has to sell it. This adds even more inventory to the fire sale, driving prices down further and accelerating the doom loop. It is a self-reinforcing cycle of destruction that feeds on itself, becoming more violent with every rotation. And sitting right in the middle of this grinder are the pension funds that manage the retirement savings of America's teachers and firefighters. Funds like Cal's TRS and the New York State Common Retirement Fund have allocated billions to private real estate strategies. They were told that these investments were immune to the volatility of the stock market, a steady source of income. That lie has just been exposed, and the write-downs that are coming will leave a massive hole in their funding status. This means that either taxes will have to rise to bail out the pensions, or retirees will see their benefits cut. The China dump is essentially a tax on the American public, levied through the destruction of their retirement assets. But the damage is not evenly distributed. It is concentrated in the superstar cities that drove the economy for the last decade. New York City is facing an existential crisis as its tax base, which relies heavily on commercial property taxes, evaporates. When a building sells for 70% less, its tax assessment eventually drops by 70% as well. This creates a fiscal cliff for the city government, forcing massive cuts to subway services, sanitation, and policing. We are already seeing the early signs of the urban doom loop in San Francisco, where the tax base has collapsed. China's liquidation of the Oceanwide and Greenland projects is the final nail in the coffin for these downtown districts. They are converting vibrant economic centers into ghost districts, where the only activity is crime and vagrancy. This drives even more tenants away, lowering property values further and spiraling the city into irrelevance. It is a deliberate strategy of economic de-urbanization, targeting the centers of Western capital and innovation. China is not just selling buildings, they are effectively shorting the future of the American city. And while the cities burn, the shadow banking sector is catching fire in the background. These are the private credit funds and non-bank lenders that stepped in when the traditional banks pulled back. They hold trillions of dollars in high-risk real estate debt, often with high leverage and floating interest rates. These funds are completely unregulated, meaning we have no idea how deep their losses actually are. But with the Chinese fire sale setting the new price, many of these funds are undoubtedly insolvent right now. They are sending out gate notices to investors, blocking them from withdrawing their money to prevent a run. If you have money in a real estate income fund or a private REIT, you might find that your capital is locked up for years. The liquidity crisis is spreading from the banks to the shadow banks, locking up trillions of dollars in wealth. This is the wealth effect in reverse. As people realize they are poorer, they stop spending money. The recession of 2026 will not be caused by a lack of jobs initially, but by a sudden evaporation of perceived wealth. China understands the psychology of the American consumer better than we admit. They know that wealth is our confidence. By destroying the value of the assets we hold, they destroy the confidence that keeps the economy moving. The timing of this attack is also perfectly calibrated to exploit the political division in Washington. With an election cycle looming, the government is paralyzed, unable to agree on a bailout or a solution. One side wants to let the banks fail to punish the woke corporations, while the other wants to print money to save them. This gridlock ensures that the crisis will deepen before any action is taken, maximizing the damage. China is counting on this paralysis. They view our democracy's slow reaction time as a strategic weakness to be exploited. We are also seeing the impact on the construction industry, which is grinding to a halt across the nation. With no financing available and existing projects selling for pennies, no developer in their right mind breaks ground today. This leads to massive layoffs in the trades. Carpenters, electricians, and plumbers are losing their jobs by the thousands. The multiplier effect of construction is huge. Every dollar spent on building generates $3 in local economic activity. When that spending stops, the local economy enters a deep freeze that is hard to thaw out. We are looking at a lost decade for the construction sector, similar to what Japan experienced in the 1990s. And just like Japan, we are now burdened with zombie banks that are alive on paper but dead in reality. These banks exist only to service their bad loans, unable to lend to new, productive businesses. This stifles innovation and growth, turning the dynamic U.S. economy into a sclerotic, slow-growth giant. The $300 billion dump is the catalyst that pushes us into this Japanification trap. But unlike Japan, we do not have a high savings rate or a cohesive society to buffer the shock. We are a nation of debtors living paycheck to paycheck, ill-equipped for a prolonged economic winter. The social unrest that will follow this banking crisis is the X factor that models cannot predict. When people lose their savings and their jobs because of a foreign adversary's financial move, anger boils over. We expect to see protests outside of bank branches and city halls as the reality of the situation sinks in. The narrative will shift from market correction to financial warfare, fueling nationalism and demand for retaliation. This brings us closer to a kinetic conflict, as economic sanctions give way to more direct confrontations. The U.S. government will likely respond by freezing the remaining assets of Chinese companies, a tit-for-tat escalation. But the capital has already left the building, the horse is bolted, and we are just locking the empty barn door. The genius of the Chinese move was the speed. They executed the dump before sanctions could stop them. Now, they are sitting on cash, while we are sitting on a pile of depreciating rubble. We must also consider the role of the offshore markets in amplifying this crisis. Much of this debt was packaged and sold in London and the Cayman Islands, outside of U.S. regulatory reach. This means the contagion is global, affecting European and Asian banks that bought into the U.S. real estate safe haven myth. We are seeing stress in the German banking sector, which is heavily exposed to U.S. commercial property. If a major European bank fails because of this dump, the crisis goes global instantly. It triggers a euro-dollar squeeze, where the demand for dollars spikes as everyone scrambles to pay debts. This pushes the value of the dollar up, which ironically hurts U.S. exporters in emerging markets. It is a chaotic, multi-front financial war, where the alliances are shifting and the casualties are mounting. The China dump is the first shot in a new kind of world war, fought with capital flows and interest rates. And right now, the United States is losing because we refuse to believe that our debt could be weaponized. We thought that King Dollar made us invulnerable, but debt is a double-edged sword. When your enemy owns your debt, they own the option to destroy you whenever they choose. That option has been exercised, and the margin call is due. The regional banks are the first line of defense, and they are crumbling under the pressure. We are hearing reports of emergency liquidity requests flooding the Federal Reserve's discount window. This is the secret lifeline that banks use when they are desperate, and usage is at an all-time high. The system is flashing red warnings that are invisible to the public, but blindingly obvious to insiders. The plunge protection team is undoubtedly active in the stock market, trying to mask the rot in the bond market. But they cannot hold back the tide of $300 billion of real selling pressure. The gravity of the situation is pulling everything down, regardless of the manipulation. You need to understand that this is not a temporary dip. This is a structural break in the market. The old valuation models are broken, and the new ones are terrifying. A building is only worth what someone will pay for it. And right now, China has set the price at rock bottom. Until that inventory clears, which could take years, the U.S. banking system is paralyzed. This paralysis is the goal, a weakened, distracted America unable to project power abroad. While we are busy bailing out our banks, China is securing resources and alliances in the global south. It is a masterful geopolitical gambit, played on the chessboard of Wall Street. And the pawns in this game are your deposits, your home equity, and your retirement fund. The CRE fire sale is the event that separates the prepared from the victims. Those who understand the doom loop are moving to safety, getting out of debt, and securing real assets. Those who ignore it are walking blindly into the greatest wealth transfer of the century. The storm is here, the dam has broken, and the water is rising fast. The question is no longer if the banks will fail, but when and how many. The most dangerous time in any banking crisis is always the weekend, specifically the 48 hours between Friday market close and Monday opening. We are approaching a black weekend, where the fate of the American middle class will be decided behind closed doors in Washington and Wall Street. The $300 billion liquidation order from China has set a fuse that will likely detonate when the markets are closed to the public. Regulators prefer to seize banks on Friday nights because it prevents the immediate visual panic of people banging on locked glass doors. By the time you wake up on Saturday morning, your regional bank might no longer exist as an independent entity. Instead, you will see a press release from the FDIC stating that the assets have been placed into a receivership to protect depositors. But you need to understand what protection actually looks like in a systemic crisis of this unprecedented magnitude. The standard insurance limit of $250,000 was designed for isolated failures, not a cascading sectoral collapse. There are trillions of dollars in uninsured deposits sitting in these regional banks, mostly payroll accounts for small businesses. When Silicon Valley Bank failed in 2023, the government broke its own rules to bail out the uninsured depositors to stop the contagion. But in 2026, with inflation raging and the political climate toxic, a universal bailout is mathematically and politically impossible. The Federal Reserve simply cannot print enough money to cover the losses generated by a $300 billion asset write-down without destroying the dollar. This brings us to the terrifying reality of the bail-in laws that were passed quietly after the 2008 financial crisis. Under the Dodd-Frank Act, banks are legally permitted to convert your deposits into equity to save the institution from insolvency. This means that if your bank fails, you do not get your money back. You get worthless stock in a failed bank. You stop being a customer with a savings account and instantly become an unsecured creditor with a claim that may never be paid. This legal mechanism was designed to protect the taxpayer, but it does so by sacrificing the depositor. The China dump has pushed the banking system into the exact zone where these bail-in protocols are triggered. Beijing knows this. They understand the legal architecture of our system better than the average American account holder does. They know that forcing a bail-in event will shatter the public's trust in the U.S. banking system permanently. Once the public realizes that their deposits are not safe, the velocity of money collapses and the economy grinds to a halt. We are staring at the precipice of a trust crisis, which is far harder to fix than a liquidity crisis. You can print money, but you cannot print trust once it has been incinerated by a loss of wealth. The FDIC's Deposit Insurance Fund currently holds roughly $120 billion in actual liquidity. That sounds like a lot, until you realize it is trying to insure nearly $20 trillion of total deposits. The coverage ratio is less than 1%, a fractional reserve of insurance that fails immediately under stress. With China dumping $300 billion in assets, the losses could easily exceed the entire balance of the insurance fund. This means the FDIC itself would be insolvent, requiring a bailout from the U.S. Treasury to continue operating. We are looking at the bankruptcy of the safety net itself, the final line of defense for the American saver. This is why the smart money has been moving into short-term U.S. Treasuries, which are held directly with the government. A Treasury bill is the only asset that eliminates the bank risk because you are lending directly to the state. But for the millions who are slow to react, the trap is closing, and the bail-in is the mechanism of capture. The government's solution to this catastrophe will likely be the rollout of the central bank digital currency, or CBDC. They will frame it as a rescue mission, offering to deposit Fed coins directly into the wallets of victims. They will say that the commercial banking system is too fragile and that you need a direct account with the Federal Reserve. This is the ultimate centralization of power, using the crisis created by China to implement total financial surveillance. Your new digital dollars will come with strings attached, expiration dates, spending restrictions, and negative interest rates. The China dump serves as the perfect pretext for the implementation of this draconian monetary control grid. It is a problem-reaction solution cycle. China creates the problem, the panic provides the reaction, and the CBDC is the solution. But what happens to the physical cities that have been hollowed out by this real estate fire sale? We are looking at a decade of litigation as banks, developers, and bondholders fight over the scraps of the urban core. The courthouses will be clogged with foreclosure filings, bankruptcy petitions, and lawsuits against the Chinese developers. Meanwhile, the buildings themselves will rot, their maintenance budgets cut to zero by absentee receivers. We will see the rise of squatter cities within our skyscrapers, as empty luxury towers are commandeered by the homeless. This social decay is the visible scar of the financial war, a daily reminder of the wealth that was extracted. China's strategic objective was not just to lose money on real estate, it was to break the American spirit. They are playing a game of Go surrounding our economic territory until we have no moves left to make. By destroying the value of our assets, they reduce our ability to fund our military and project power abroad. An America that is busy bailing out its banks is an America that cannot defend Taiwan or the Philippines. This is the geopolitical checkmate that was hidden inside the balance sheets of the property developers. So, what can you do in the face of this tidal wave of deflation and systemic risk? The first step is to aggressively reduce your counterparty risk by diversifying where you hold your liquid wealth. Do not keep all your eggs in one basket, especially if that basket is a regional bank with real estate exposure. Open accounts at multiple institutions, preferably the systemically important banks that the government cannot allow to fail. Consider moving a portion of your cash into physical assets that sit outside the digital financial system entirely. Gold and silver have historically been the only insurance against a banking crisis that actually pays out. They have no liability, no board of directors, and no exposure to commercial real estate loans in San Francisco. Bitcoin, if held in self-custody, also offers a digital lifeboat that cannot be bailed in by a desperate bank. But you must hold the keys yourself. Leaving crypto on an exchange is just trading one bank risk for another. You must also eliminate your own debt, specifically variable rate debt that will spike as the crisis unfolds. The banks will try to recoup their losses by jacking up interest rates on credit cards and lines of credit. Do not be the victim that pays for their bad bets on Chinese-owned office towers. Pay down your liabilities now, while you still have the liquidity and the cash flow to do so. We are entering a period of return of capital being more important than return on capital. The goal for 2026 is survival, preserving your purchasing power while the system burns down around you. Do not chase yield in risky bonds or stocks. The risk premium is nowhere near high enough to justify it. The stock market is not yet priced in the full impact of a banking sector collapse on corporate earnings. When credit contracts, earnings contract, and stock prices will follow gravity eventually. The buy the dip mentality will be punished in a credit cycle downturn driven by asset liquidation. China has signaled that they are leaving the Western financial ecosystem and they are taking their ball home. This de-dollarization is not just about currency, it is about unwinding 40 years of economic integration. The pain of this separation will be felt in every portfolio, every pension, and every paycheck in America. We are witnessing the end of the chimerica illusion, the idea that two rivals could be economic partners. The partnership is over, the divorce is messy, and the assets are being sold on the courthouse steps. You must accept this new reality and position yourself accordingly, or you will be collateral damage. The world of 2026 is a world of hard borders, capital controls, and financial warfare. The CRE fire sale is just the opening salvo in a much longer conflict for economic dominance. But knowledge is your armor in this fight, and preparation is your shield against the fallout. You have the data, you see the trend, and you understand the mechanics of the trap. Now it is up to you to take action before the weekend press release freezes your accounts. The window of opportunity is narrow, and the heavy doors of the bank vaults are slowly swinging shut. Don't be the person standing outside on Monday morning wondering where your life savings went. Be the person who saw the signal, understood the risk, and moved to high ground before the flood. This is the reality of the great deleveraging, and it will redefine wealth for a generation. We will continue to track the flows, expose the lies, and bring you the truth every single day. If this report helped you understand the gravity of the situation, please hit the like button to share it. Subscribe to Finance Mind and turn on notifications so you never miss a critical alert. The financial war is escalating, and we are your frontline intelligence source in the chaos. Share this video with your friends and family. They need to know what is coming for their bank. Stay liquid, stay diversified, and most importantly, stay vigilant in these dangerous times. Thank you for watching, and we will see you on the next update.